I had a request a few days ago when I discussed the performance of a mixed portfolio of 35% gold and 65% stocks. I was asked if I had any data showing how mixtures of various amounts of stocks, bonds, and gold worked out. As it turns out, yes, I did. I had conducted a fairly thorough analysis, but didn't know if my audience on this channel would have any interest in it. Now that I've had the request, I decided to make a video out of it. Let's start with the assumption of 0% bonds in the portfolio. This curve represents various mixes of gold and stocks in 10% increments. On the vertical axis is how the given portfolio of stocks and gold performed from 1971 through the end of 2019 in terms of annual percent return. Now, why did I pick 1971? Quite simply, it was the year in which the monetary regime completely changed and the Federal Reserve note was no longer tethered to gold as a government fixed price. The horizontal axis represents the predictability of the portfolio performance. You don't really have to know much about logarithms or nonlinear statistical analysis. Just realize that it's a measure of how far away from the trend line the performance of the portfolio wandered over short periods of time. The farther to the right any point is, the less predictable its performance was. A 100% stock portfolio is in the upper right-hand corner of this chart. Its CPI-adjusted rate of return over this time period was a little greater than 7% per year, but it was not very predictable, as evidenced by the fact that it is towards the right-hand side of the graph. Shorter time frames saw the performance of stocks deviate widely from the trendline return. A 100% gold position is shown in the lower right. It had a CPI-adjusted rate of return of close to 1.5%. but was even more highly variable in terms of performance than stocks. So one can understand why many financial experts, again, note my verbal use of air quotes here, shun gold. The problem is that they don't really know what they are talking about. But then again, isn't that true of most experts? Look what happens when we add a little gold to an all-stock portfolio. Adding just 10% improves the predictability of the return significantly, but only reduces the expected return by a little bit. A 20% gold, 80% stock mix is even better. The most predictable mix is 35% gold and 65% stocks. The average annual return went down by about 1% relative to the all-stock portfolio, but the predictability improved considerably. But what happens when we add some bonds? Let's add another curve that has 10% bonds and then varies the stock and gold amounts. Notice that the new curve has fewer points. It has to, because we've now used 10% of it for bonds. So in the upper right-hand corner of this curve is a mix of 90% stocks and 10% bonds. The lower right is no stock, 10% bonds, and 90% gold. The entire curve moved to the left, which is good, but it also moved down, meaning that we're sacrificing more return to improve predictability. So let's add more bonds. Here's a new curve with 20% bonds. Again, the curve moved to the left, but it also moved down. So let's add more. Here's a curve with 30% bonds. We're starting to sacrifice quite a bit of return for a small benefit in predictability. So let's fill in all possible mixes. Here are all of the possible curves containing various mixes of stocks, bonds, and gold in 10% increments. It will probably take quite a bit of time to digest all of this information, so please pause the video and study it if you need to. I'll just point out the highlights now. I've connected all of the dots that don't have any gold with a blue dashed line. These represent the traditional portfolio mixes promoted by the financial experts. Again, note the use of verbal air quotes. What they generally recommend is that a person reduce stock exposure and increase bond exposure with age based upon some simplistic formula such as subtract your age from 100 and that's the percent of stocks that you should have. The rationale is that the more predictable the rate of return is, the less disastrous a few bad years of stock market performance can be for those who can least afford it. But doesn't it bother anyone that there are portfolio mixes that perform much better from the standpoint of both predictability as well as expected return than the ones that the financial experts are recommending? I mean, after all, a 35% gold, 65% stock portfolio was not only more predictable, but also had a 2% greater return than an all-bond portfolio. It also beat the pants off the classic 60% stock, 40% bond portfolio. But I'll go farther and make a bold statement. According to the historical record, adding some bonds to a stock and gold portfolio mix did in fact reduce risk, but only by a little bit. Doing so came at the expense of a very punishing reduction in rate of return. So the conclusion that I draw from all of this is that bonds offer a really crappy risk versus return trade-off in a portfolio. Taking into account the current very low interest rates, I think they should be avoided. And when it comes to gold, the air quote financial experts have it all wrong. They are blind to what in modern portfolio theory is essentially a free lunch. And the reason that they are blind? It's because of a simple axiom my PhD advisor taught me a long time ago. The definition of an expert is a person who is often wrong, but seldom questioned or in doubt. Got gold? I had a request a few